Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. I drew 6 weeks ago an early July to mid-November 2023 bearish Andrews pitchfork, which I have since highlighted in purple on my daily chart. At the time, it was more a way of expressing the bearish angle of attack here than for anything else. And in this, it has been accurate in showing the way lower and the bearish angle of attack. Even now, after the rise was seen since late February. I draw your attention to last week's high at 1240, which briefly touched the descending upper time, currently at 1231, before pulling back lower. Now, this turn upwards was both surprising and amazing, as we really had no further support below until the 61.8% absolute Fibonacci line at 1106. So from the December 2020 low, prices turned back up, pushing through congestion in the 1161 area, then at 1161 to 1177, then the 2021 low at 1181, the May 2023 low at 1193, and a December 2021 low at 1223. But most important of all, prices pushed up through the green highlighted slowly declining short medium moving average, currently at 1196, and is now using this as a support with the upper time as resistance. At the moment, all this doesn't stop the bearish Andrews pitchfork from still ruling the market, but it does raise the question as to whether we may be or have already seen the beginnings of a strategic change. The upper time and the short medium moving average may well cross over in a couple of weeks, so it'll be most interesting to see which is the stronger. For good order's sake, beyond the upper time we have the congestion at 1243 and the declining medium moving average currently at 1257. To add to the discussion, I said the following 2 weeks ago, and I quote, "The one thing such a move higher might start is discussion. If the November 2023 today action is a potential descending scallop pattern. The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal, and that is the well highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either." Chicago soybean meal. After establishing a horn top in mid-November 2023, prices dropped with some hesitations and eventually reached the congestion down at 326.90. However, the congestion was different, as we have crossing through it the extension to the lower trend line, currently at 326.90 also. That's the congestion down there. And that's of the July to September 2021 descending triangle. I've highlighted this trend line in dark blue on my daily chart. Now, as I said 4 weeks ago, and I quote, "This may be nothing, but I'm minded after such a fall as we've seen since last November last year, that this may see some hesitation around the 327 to 325 zone. I'm not certain of that, but it is worth considering. However, the overall pressure is still bearish. We must now consider the congestion in January that ran into early February as a possible bearish halfway hesitation," end of quote. Now, the question I posed over the last few weeks was, and I quote, "Where to measure it from? The most obvious immediate point is the uptick in late December, in which case it will provide us with potential down to just a little under where we are now in the low 320 zone. However, if we were to consider the move starting at the high in November last year, then there is potential down into the 270 zone, well below the bottom of my daily chart. It's too early to say whether the 270 zone will become a target or not, but it is worth considering, end of quote. Well, it seems for the moment that such a question was too early, as prices utilized the extension to the descending triangle as a base and rallied back up through the 61.8% absolute Fibonacci line at 336.30 and even briefly over the green highlighted short medium moving average, currently at 344.30, before succumbing to the bearish pressure this exerted. This seemingly defines where the topside pressure is coming from, this slowly declining short medium moving average. However, this is within a very recent and possibly larger pattern, a March-based bull channel, currently 340 to 355.80, which I've highlighted in bright red. Now, these forces are due to clash next week, and I'll be interested to see which one wins out. I suspect the one still standing may point the way ahead for the immediate future, but we're already seeing that happen today as the market has busted through, but not closed yet, busted through the lower bull channel line, the bright red bull channel line. Finally, I will raise once again the one key feature I need to repeat and emphasize, as I have done so in the past. I raised it as a possible feature 41 weeks ago, and it came to fruition at the close of 2023. It was that the whole of 2023 was an annual key reversal down year. This hangs over all this market more than anything else right now, and all actions should be seen in the shadow of this pattern. Chicago soybean oil. At the turn of the year, the market broke down through the 38.2% Fibonacci line of 48.95. We had the opportunity to form a very extensive bearish halfway hesitation, with potential being as low as below 40 even. However, the decline had been a lot shallower than in previous moves. This was possibly dictated on top by the now flatlining short medium moving average, currently 47.13, that is highlighted in green on my daily chart. Prices went down to the area of congestion we last saw in May 2023, consisting of three, possibly four bands. These were, and are, 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 2023 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. Then the interesting 42.65 congestion, which has the neckline highlighted in bright red of the October 2019 to February 2020 head and shoulder top running just above it, currently at 43.09. Now, I mention all these because some 38 weeks ago and numerous times since, I said the following about the big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. I said the following, and I quote, "I would consider that this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern," end of quote. This is a big pattern idea, and the market decline since autumn of last year fits in with this idea, with the exceptions I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even to 46 even zone, which is where we've recently been. I've often stated here that I am keeping a very, very close eye on this idea, as any significant breakdown below 48 even to 46 even zone could signal the start of this move lower. I said 3 weeks ago, and I quote, "So far I'm not convinced of the move, that we've seen this break lower already. No, not just yet. However, three things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date. So do not expect any immediate sharp movements. Secondly, data indicates that about 3 out of 4 times the market breaks lower. Just be aware of that. Finally, I would like to float the idea of a recent unusual bear channel," end of quote. Now, I've highlighted the bear channel dating from the start of 2023 in dark blue on my daily chart, and that's currently 42.52 to 47.65. I also at the time chose to highlight the declining short medium moving average in green, as there was some pedigree in this moving average, as it had capped the market in late November last year, mid-December, and most recently mid-February this year. I had for a while utilized this moving average as the upper bear channel line, as you can see, before I drew a proper upper trend line. Well, 2 weeks ago, the market punched up through it. The first time pushing and closing over both the short medium moving average, well, over the short medium moving average since June last year. What is more, the market continued to rise, and yes, they punched up and closed over the upper bear channel line. The cap for a while on the market was the mauve highlighted slowly declining medium moving average. So that was the punch up was 2 weeks ago. This medium moving average, however, this was not enough as a resistance, and it required the additional forces mustered by the significant 38.2% Fibonacci line of the March 2020 to April 2022 move at 48.95, plus the congestion between 49 to 51.25 to erode the move higher, despite consecutive closes over both the medium moving average and the 38.2% Fibonacci line. Okay, so last time I thought there might be sufficient ammunition below to take on this overhead congestion, should the market choose to do so. However, this is a question that is still open, nearly 3 weeks after the market started tackling it. And the longer it takes, the less likely is the result positive on the upside. This brings me back to the recent bear channel in dark blue. 2 weeks ago, I laid out some potential targets overhead for a break of this pattern, and I quote, "So a primary target X would be in the 49.65 area, an area that we've almost reached. For secondary harder to reach, target X1 up in the 51.95 area." Well, the market reached the primary target at 49.65 and reached it again, and almost the third time. But late this week, prices have dipped, and we are now either side, well, just below or either side. We're around we are around the mauve-colored medium moving average, and seemingly rising, moving down to rise along the top side of the slowly declining upper bear channel line, currently at 47.65, to ride down along it. In 2 weeks or so, we may see the flatlining green short medium moving average start interacting with the upper bear channel line, and it will be interesting to see what happens next. For the moment, I will leave target X1, the secondary harder to reach target, up at 51.95 on my daily chart. I make no assurances as to whether I will keep it there or not. Now, one final point, and it is more an observation rather than a definitive point. For some reason, I can see the beginnings of a possible reverse head and shoulder pattern developing this year. We are maybe forming the second shoulder right now, or we may be not.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.